Good evening once again to everybody, and welcome to this particular session of our bootcamp series. So today is going to be the 8th day since we started, and the topic for today is going to be liquidity, like I've said already. Okay, we're going to be talking about liquidity, what is liquidity, and what it means when it comes to trading. All right, so that's our topic today, liquidity. Now, just as it is with a short form like this, or just this particular small word, it means a lot in the forex community. It means a lot. Now, what is liquidity? Okay, that should be the question you must be asking yourself now. So now liquidity here it simply means it's simply the flow of orders in the market. All right. Liquidity here is simply where the amount of money or the amount of orders that is it concerns money. I don't want to go into it a lot of so many, I mean like so many stories again. Okay, so we know that liquidity is equal to money. All right, this is what liquidity is all about. Liquidity in the forex market is equal to money. Okay, so now if liquidity now is equal to money, now I want you to understand something about the market. The market will always go to where there is money. Okay, the market always go to where there is money. Now, even in our local communities, if you notice where our markets are always located, they are located where there will be traffic, where there will be money. Okay, you cannot carry a market and you go with it right inside the bush where there will be no people to bring in money to that particular market. So now what does this mean? This means that the market is always going to where there is money. Okay. So which well, we are when I say the market here, I'm talking about the charts. All right. Which means that as you're looking at the chart, as the chart is going down, it's following where there is money. It's going in search of money. Okay. So the main thing, the main phrase that you should keep in your mind as we proceed with this particular explanation is that the market is always looking for money. Okay. The market is always looking for money. Where there is money, that's where the market is going to. Okay. The charts will always go where there is money. All right. So the market is always looking for money. Now, this money in the market is located in form of orders. Like we talked about types of orders. All right, types of orders like you have your buy orders, that's instant orders. We have pending orders like buy stops, and then we have buy stops and sell stops, and then we have your stop loss. Okay, you have your stop loss and you have your take profit. Now, these are where there is liquidity. All right, where your stop loss is, where your take profit is, where your buy stop or sell stop order is. That those are the areas that you have liquidity sitting on. You understand? Now, which means that if you have a high like this, if you have a high like this, okay, and then now what will be sitting above this particular high? All right, what will be sitting above this particular high? Now, people who sold, all right, people who sold are putting their SL above this high. What is SL? SL is equal to money, all right? Which means that if the market should come up to clear your stop loss, that is where your money was sitting, okay? That's where your money was sitting. Now, if the market should come to clear your stop loss, then at that time, the money that you put in the particular trade, it's going to be deducted now from your account, which means that your money now have been taken away, all right? Now, which means at this point that that is your stop loss here is equal to money, all right? It's where money is sitting. All right, because there are going to be a lot of traders who are selling and they're also putting their stop loss here. So SL, your stop loss is equal to money. Remember, we said money is equal to liquidity. So what happens is where you're putting your stop loss is equal to where there is money. Understand? Now, if you're putting your take profit right down here, okay, where price actually came down and took this swing low where your take profit was sitting. Now, at this point, your trade is going to be closed and the profit will be sent to your account. What does this mean? This means that your TP that was sitting right down here is equal to money. Okay, that was liquidity. The market was coming for this liquidity here, which other people that were buying, they're also having their stop loss here. But now your TP is also around this point. So at this point again now, that's where there is liquidity. Okay, so your TP, your stop loss, your buy stops, and your sell stops, those are where there is liquidity. Now, in general, market orders, all right, market orders, okay, anywhere that you can have a market order, that particular point is equal to liquidity. Okay, anywhere that you have a market order, it's equal to liquidity everywhere in the market. All right. Now, if you don't have an idea about market orders, you should go back to the first videos that we made, which were talking about instant orders like buy, immediately sell, or you use pending orders like a buy stop. All right, a buy stop and then a sell stop. I'm not going to be talking about that in this particular lesson. All right. So remember, like I said, where there are market orders, that's where liquidity is sitting. Now, we actually have two types of liquidity. We have external liquidity and we have internal liquidity. Now, this will be explained in the form of an uptrend and a downtrend. All right. Now, let me first of all do this. Now we are in an uptrend. Okay. Now, when I gave you the explanation there on the first when we started technical analysis, actually above this high, when price is in an uptrend, okay, when price is in an uptrend, it's actually respecting, that is, it means demand is in control, right? Now, demand is in control. Now, if demand is in control, what will happen? The market will be looking for liquidity, but going to the upside. Now, which type of liquidity is that? We call it buy side liquidity. All right, buy side liquidity. You can put it BSL, buy side liquidity. Now, where is the buy side liquidity? Remember, we say liquidity here is equal to stop loss, your market orders. So, which means every swing high you see in the market, every swing low you see in the market have market orders sitting at that point. All right. Before the market sold like this, there were traders that were selling and putting their stop losses here. Before the market bought, traders were buying. Before the market bought, traders were buying. Before it sells, traders were selling. And if they are selling, they are putting their SL and so on. Others are putting their buy stops here. So every swing high or swing low that you see in the market has liquidity. Every swing high or swing low you see in the market has liquidity. Okay. Every swing high or swing low you see in the market has liquidity. Now, for you to differentiate which type of liquidity that it's there, all right, you will now know when I say buy side liquidity, I mean liquidity that is found in a swing high. All right, this is where you have buy side liquidity. All right, that's where you have buy side liquidity. And where you have sell side liquidity is down or it's on the swing low. Okay, so every swing low have sell side liquidity. Every swing low have sell side liquidity. And every swing high has bet what? Buy side liquidity. Buy side liquidity. Buy side liquidity. You understand? Now let's do it again this way. So this means that we have something like this. We have a market is actually in an uptrend. Okay, a market is in an uptrend, creating higher highs and higher lows, creating higher highs and higher lows. Now it breaks a higher low and starts to be in a downtrend. Okay, now this means that when the market was in an uptrend, at this point, it was looking for buy side liquidity. Okay, the market was looking for buy side liquidity when it was in an uptrend. It was looking for buy side liquidity. Why? Which type of buy side liquidity? This external buy side liquidity. These swing highs. Okay, all these swing highs, we having buy side liquidity. That's what the market was looking for. All right. Remember, I said the market is always looking for where there is liquidity. The market will go to where there is liquidity. The market will go to where there is liquidity. That's why when you're in an uptrend, the market will constantly be taking old highs. The market will constantly be taking highs like this taking highs like this and so on and so forth until the liquidity is finished now. Then the market will now tend to target all this sell side liquidity. You understand? The market will not tend to target the sell side liquidity. But remember, I said above is buy side liquidity. Every swing high has buy side liquidity. Buy side liquidity, and every swing low has sell side liquidity. Okay, now which means that even in a downtrend like this, what is sitting above this point is buy side liquidity, and what is sitting here is sell side liquidity. But now in a downtrend, the market is looking for sell side liquidity, not buy side liquidity again. You understand? That's why these old highs will not be attacked again, will not be taken out. Instead, price will now be taking the old low, the swing lows. Why? Because there is sell side liquidity and the market is looking for sell side liquidity. But now, how do you get the hint? When the market is breaking structures, that confirms an uptrend. All right. Now, when that confirms an uptrend, it's an indication that the market is out looking for buy side liquidity. Okay, the market is looking for buy side liquidity, and until it starts to break a low like this, which indicates a downtrend, that's an indication now that the market is no more looking for buy side liquidity. It's now looking for sell side liquidity. All these swing lows, okay, all these swing lows now, the market will be looking for sell side liquidity. Remember the phrase I told you that what the market is always the market always looks for liquidity. Okay, the market always looks for liquidity. Market books on liquidity all the time. That's the nature of the market. It books on liquidity. Where liquidity is sitting, that's where the market will go to. I don't want to put it too advanced for your understanding, but I want you to understand it in this simple and basic nature that the market is always looking for liquidity. Wherever you see an old high or an old low, if you see market structure breaking, if you see market structure to that direction, that's where the market is going for. That's what the market is going there for. Now, let's look at it again in this way. All right. Now we have an old high here. And then now the market came down, and then now it breaks structure at this point. All right. Now, this is an old high. What is sitting above this old high? All right. What is sitting above that old high is called buy side liquidity. All right. What is sitting here is called buy side liquidity. It's a swing high, right? Now, the market starts an uptrend. The market has started an uptrend. Okay. The market has started an uptrend. Now, when the market starts an uptrend here, your target, if you are buying at this point, you need to know where price is going to. That is the more reason why we are studying liquidity, because the market cannot be an uptrend and you are just foolishly buying. You need to know why you are buying and where price is going to. All right, so that when price gets to your particular target, you'll be able to close the trade now and wait. All right, and wait for the next draw on liquidity. Now we say if the market we have an old high here, which is buy side liquidity here, and now the market started breaking a structure here. What this is called BMS, break of market structure. So the market has broken a structure here, and now we buy at a discount. All right. Remember the lesson we talk about ranges. You buy now at a discount. Now, if you're buying at this point, why are you buying, or where do you think price is going to? That answers now the question of liquidity. Remember, I said the market is going where there is liquidity, or the market books on liquidity all the time. It books on liquidity all the time. Now, if you buy here, where are you going to close your trade? Where are you going to take profits? It should be at this high. All right. Why? Because the market is coming for that high. And now, when it takes this high now, what will definitely happen is that you see this old high, old low here. If the market should break structure at this point now, after taking the liquidity that was sitting above this high, we will now have it in mind that the market is coming back now for what? The sell side liquidity that is sitting below this point. All right. Why? Because the market have broken structure. Okay, because it could take this high and still continue pushing up. But if it comes back down to break a swing low like this, all right, that's an indication that we are now coming down for sell side liquidity. And now, if you should sell from the premium here, all right, expecting price to now come down so that you close your trade on this low. Remember, I said if you break the structure, that means, all right, that indicates that actually we are done looking at the buy side liquidity and the market now is interested in looking at the sell side liquidity. Okay, so we will not expect prices to continue dropping. All right, we'll not expect to see lower prices till the sales and liquidity is taken. All right, now as we proceed, if you have a question or is there's something I've mentioned you're not understanding, just leave it on the chat box and I'll get to it. Okay, now let's look at it on the chart. Remember I said when you are on a down, when any swing high, a swing high like this has what? Buy side liquidity. Remember I said we have two types of liquidity. We have external and internal liquidity. Now, internal liquidity is in the form of order blocks and fair value gaps. We're actually going to talk about that. Now, we have buy side liquidity, and what is sitting down here is called sell side liquidity. All right, every swing low has sell side liquidity and every swing high has buy side liquidity. Now let's look at this thing on the chart and then I'll give you an exercise. Okay, now you will notice that at this point when the market started a downtrend, actually we were first of all bullish, right? The market was like kind of creating higher highs and higher lows. Now when it started a downtrend, when the market started a downtrend, when it started breaking lows, old higher highs that were formed, when it started breaking it, what that was a signal now that we are now looking for sell side liquidity. Now, if the market should break a low like this and then you sell, all right, this is simply the explanation that we talked about the last time. Now we broke a structure. Now price went back up. Now you see the trend, all right. When it comes back up, you sell. Now, where are you selling to? That should be the question you should ask yourself. Where is the sell side liquidity that the market is going down for? And now, if you try to look at this point, you will notice that if you started selling from here, you will notice that we're having a low here that is called, there is a lot of sell side liquidity sitting here in the form of this low, this low, this low. We call it triple bottom. All right. Now, all this here is called, all this here are sell side liquidity that is sitting here. So which means that if we sell from here, we are going to be closing our trade when the market takes this sell side liquidity. Okay. And what happened? All right, the market came down and then it took the sell side liquidity. You understand? Now, if now at this point that we have taken the sell side liquidity, if we now start to see price break a structure go to the upside, what will be our target? We'll now start to target where the buy side liquidity, which will now be this old high. This old high now has what we call the buy side liquidity. Okay, we're having a buy side liquidity at this point now. All right. So now, if the market at this point, all right, it was in a downtrend. This is actually a downtrend, right? But now, if the market should break an old high, starts to give us an uptrend, our target as we're going to be buying, we are going to be buying targeting this old high. Because what? If the market is in an uptrend, it's looking for buy side liquidity. And you continue looking for buy side liquidity till the buy side liquidity is finished before the market will not change direction now to start looking for sell side liquidity. So we are going to have something like this. If we start to see a break of structure here, this is what we are going to have till this buy side liquidity is taken. And now when this buy side liquidity is taken and you close your trade, what next should you be waiting for? If you now see another break of structure to the downside, what does that mean? This means that we are going to be targeting another new sell side liquidity like this one now. All right, this is going to be sell side liquidity, and then you should now expect prices to continue dropping down. All right, we should continue in a downtrend till we come down, clear this sell side liquidity. Now, again, price can clear this sell side liquidity and continue to go down. All right. After clearing that sell side liquidity, price might continue to go down. Price might continue to go down. So it doesn't mean that when immediately price clears a low or a high, you should start buying because it has taken sell side liquidity or buy side liquidity. No, it can take and continue going down. All right. But now what you are expected to do is immediately, anytime you see a break of structure now, know that the sell side liquidity hunt is now over, and then you should now start looking for buy side liquidity till the buy side liquidity is completely taken, and then you should now start expecting buy side liquidity, sell side liquidity. Okay, so this those does this necessarily mean the graph in forex are just repetition? Actually, it's repetition in the form of waves. All right, it doesn't mean that. Anyway, they used to say for history repeats itself, but this doesn't mean that this exact chart you are seeing right now, it doesn't mean that this exact thing you are seeing right now will happen again in the days ahead. It can be similar due to some factors, but it's not going to be exactly the same. It's not going to be exactly the same candles that you are seeing, but it can be a similar downtrend like this. Okay, because like I said, we have just three phases of the market. We have just three phases. What? An uptrend, a ranging market, and then what? A downtrend. So which means that we are going to have a lot of series of downtrends, series of uptrends, but that doesn't mean that they are the same. All right. So I think that answers your question, right? Because now at this point, this is a quick uptrend here. All right, this is a quick downtrend. But now, if you want to study this downtrend and then looking at this one as well, you will notice that this downtrend and this one, they are not the same. But the fact that they are in a downtrend, they have series of lower lows and lower highs, lower lows and lower highs. That is their similarity. But talking about this exact thing being here, it's not possible. All right, it's not really possible because there are different factors that forms these particular candlesticks. You understand? Okay. So, all right. Think you understand now. Okay. So the market is always looking for liquidity. All right. This reinforces your market structure that I told you. It reinforces your market structure. Like if you're in an uptrend, starting from here, where should you stop expecting an uptrend? So does this work for all time frames? If not, what is the best time frames for this analysis? It works on all time frames. It works on all time frames. All time frames. I think I explained this in one lesson like that. It works on all time frames. Why? Because they used to say that price is fractal. Anything that can happen on the 1 year chart can happen on the 1 minute chart. If you go to the 1 year chart, you can still see a downtrend like this. If you go to the 1 month chart, you are still going to see a downtrend chart. Now, this is a 1 hour chart, right? This is a 1 hour chart, and we are seeing a downtrend, which means that if you go to the weekly chart and then you try to look, you are still going to see price forming downtrends and so on. Okay, so it doesn't really, it's not about the time frame or whatsoever. Okay, it's structure, and structure is on all time frames. You can have an uptrend in a yearly chart, in a daily chart, weekly chart, and so on. Price is fractal. Okay, but now this boils down to the type of trader that you are. If you are a scalper, which means that you can take a trade and close in the next 1 minute. Now, in the next 1 hour, all right, it means that you're going to be looking at a structure from the 3 minute and the 5 minute chart or the 15 minute chart. Okay, because remember I said you only buy when you are in an uptrend and you only sell when you are in a downtrend. But now, if you are a scalper and you are not looking at a 15-minute chart and you are expecting to enter a trade and make just 1 hour, how will a 1 hour candle give you a trend on the 1 hour chart? It's not possible, right? Because now let's look at something like this. Let's look at this. All right, let's just say these are how many candles? Let's say we are having 1, 2, 3, 4. We're having 4 bullish candles. Okay, that's 4 hour candles, or let's say 1, 2, 3, 4, 5. We're having 5 hour candles. This is the 1 hour chart. Now, if you cannot, this is not an uptrend. This is not an uptrend on the 1 hour chart. But now for a scalper, somebody that was entering this trade just to make like 3 hours in the trade, you will now go to the 15 minute. And now when you look at the 15 minute here, you will notice that actually you were on an uptrend on the 15 minute chart. You will notice that from here, we actually had a break of structure here. All right, we had a break of structure. Price created a swing high, came back, created a swing low, went up, created a swing high. You will now notice that every time frame has its own structure depending now on the type of trader that you are. Okay, you'll be able to know which time frame you are going to trade on. And I think we have talked about this particular lesson, right? If you are if you are still confused about time frames, you can let me know, okay? And then I'll show you a lesson that we did on that, and it's going to help you a lot. Now, the market is always looking for liquidity. The market is always looking for liquidity. The market is always looking for liquidity. All right. It is as simple as that. You don't have to complicate it. You don't have to complicate it. The market is always looking for liquidity. All right. Now, let's look at something here. Why did the market drop this much right down to this particular point? Let's look at it at this stage. Let's see. Let's focus from here. Okay. Let's look at this point here. We were actually on an uptrend. We were actually here in an uptrend, right? Price was creating higher highs and higher lows. What happened? We started breaking a low. What does this give you? Which type of signal does this let you know? That is, you are the market is no more interested in what? On the buy side liquidity, because you will now notice that the market has left a buy side liquidity here to take, that is to break above it, and now it has instead come back down to now clear by the sell side liquidity. And what does that explain? It now explains that the market is looking for sell side liquidity, which means that this is a sell side liquidity here, and that is going to be a target if you should start selling from here, because what the market has given you a hint that it's looking for now sell side liquidity, which means you are now in a downtrend. So the market will continue selling till it clears this sell side liquidity. If it now clears this sell side liquidity, you can now close your trade. And when you close your trade now, what are you going to be expecting? Anytime that you see price starts to break a high, what does that mean? That's going to indicate that the market is no more looking for sell side liquidity. Okay, that's the market is no more looking for sell side liquidity. And what happened? The market now has started looking for, it has started breaking highs. All right, it has broken a high here, broken a high. What does this mean now? The market is now looking for buy side liquidity. The market is now looking for buy side liquidity. And if the market is looking for buy side liquidity, if you look at my chart here, where is the buy side liquidity sitting? We have this old high here. This is what? This is buy side liquidity is sitting right above this point. So what are we expecting now? What should we be expecting? As we are seeing this uptrend, we are expecting price to continue going up, to go up, clear this buy side liquidity. But now, if we now see price starts to break this low, what does that mean? This means that the market is coming back for this sell side liquidity, and this is what is going to happen till this low is taken out. It's as simple as that. It's as simple as that. So I'm going to give you an exercise, and I'll expect you to submit it either to my DM or, all right, you can submit it to my DM. Now, this is how the exercise is going to look like. You can go into your chart, every swing high that you see, like this particular swing high, you write it down there, buy side liquidity. All right, you write it buy side liquidity. Okay, top center. Okay, this is buy side liquidity. What? This is buy side liquidity, buy side liquidity, buy side liquidity. All right, and then buy side liquidity. Okay, all these swing highs, what is sitting right there is called buy side liquidity, buy side liquidity. And now, what is sitting below is called sell side liquidity. It's called what? Sell side liquidity. Every swing low is called sell side liquidity. Every swing low, every swing low, every swing low, every swing low is called has what we call sell side liquidity. What is laying below every swing low is called sell side liquidity. Now, the market will not look for sell side liquidity if the market is looking for buy side liquidity. That explains why when you are in a downtrend, you constantly see the market breaking lows, breaking lows, breaking lows, which is what the market is constantly taking sell side liquidity. When it pulls back up to form a lower high, it comes back down to take what? Sell side liquidity. It goes back up to build to create a lower high. What happens again? It comes down now to take sell side liquidity. What happens? It goes up, creates a swing high, comes back down, and now when it starts to break swing highs, what does that imply? It implies now that the market now is about looking for buy side liquidity. Now it comes down, it creates a lower low. It doesn't take sell side liquidity here. It goes back up. All right. Now the sell side liquidity is intact, and then it takes buy side liquidity. It forms it again, come back down. It doesn't come right down to take this sell side liquidity. No, it forms a swing low, and then it goes back to take the buy side liquidity. That's how the market is. All right. The market books on liquidity from buy side liquidity to sell side liquidity. That's how the market books. All right. The market is always going where there is money. Remember, I explained that to you. If the more reason why people are importing things from China to Cameroon or to other countries is because they have seen that there's business here. All right. That's why you can go to China and then you get something at a very low cost. And then why are you bringing it here? It's because there is money here. There are people here who are in need of that particular product. So why is the market coming back to this country? All right. That's what how you should think. Okay. That's how you should think. So the market will always go where there's liquidity. All right. Now, the people that are actually importing things from China and so on, they're importing it at a lower price. They go there, they buy it at a very cheap price, but they bring it here now and they sell it at a very high price. All right. It's just the explanation. It's just like the market is trending. You go and then you come back. That's how the market is. All right. If something is not valuable at this point and it's valuable at a different country, what will happen is people, serious business people will come buy the thing and then they go sell it where there's money. So that is how the market is. The charts will always go where there is money, and where there is money is where you have your market orders. Where you have your market orders. Like I said, for buy side liquidity, what is sitting right here at the buy side liquidity is what? You have stop loss of people that were selling at the swing high. We have buy stops of people who are expecting price that when immediately anytime price takes this high, they should be buying. So we have buy stops of people and the sell and the stop losses of people at this point. So what is that? Buy side liquidity. Now, what is sitting on the sell side liquidity? All right. Every swing low that you see, what is sitting right there is what? Stop losses. Okay. Stop losses. And what again? Sell stops. Sell stops. Why is it a sell stop? Because they're expecting the trader is expecting, okay, if price should be coming down again to take this low, it means that it's going to continue a downtrend. So now my sell stop should now be activated as a sell order in the market. So which means as price exceeds this low, his sell stop is going to be activated and it's now going to become a market order. And as the market is going down, he's going to be making money. Okay. That's the function. And then for a buy stops, it's just simply the opposite. All right. So I hope you guys have understood this particular lesson. Okay. I've tried as much as possible not to make it so hard for you to understand. Okay. I've tried as much as possible not to make it for you too hard for you to understand. All right. But now this is simply how the market books. There is no other way. There's no other way. The market goes where there is liquidity. If there's no liquidity there, the market will not go. You cannot go and import things from a different country to come and then make a loss. No, it doesn't have, it can. If there's no liquidity sitting somewhere, you will not see the market going to that particular point. Okay. Is that clear? So that's it, guys. The market books on liquidity. The market will always go where there is liquidity. The market will always go where there is liquidity. Keep that in mind. Keep that in mind. And how would you know? How would you confirm that that's where the market is going to? How would you confirm? How would you confirm that's where the market is going to? Now I've given you an explanation and it's very, very clear. What? Okay. I've given you an explanation. I'm still going to do it again the last time. we have an old high here. What is sitting on that old high is what? Buy side liquidity. Now, if the market is trading at this low and you start to see the market doing what? Breaking highs, trying to form an uptrend. What does that mean? If you are buying at a premium, at a discount here, okay, at a discount of this range, then you should be expecting the market to come up to this buy side liquidity. Why? Because the market is looking for now buy side liquidity because it's forming you an uptrend. And when it takes the buy side liquidity, you can now close your trade. All right, you close your trade. But now, if it doesn't continue going up and you now see it starts to break a low, that should be a signal that it's a hint the market is giving you. And now you look at your chart, where is the CSI liquidity? We have this old low right here. We have this low sitting right down here. And now if you're selling at the premium of this range, then you should be expecting now to close your trade when the market takes this low. It is as simple as that. So I hope you guys have understood this lesson. I've tried as much as possible to make it very simple. All right. So thank you guys. Let me see your feedback on my DM. Thank you guys for joining tonight's session.